In this video, I want to introduce you to the basics of property investment valuation. The distinctive thing about investment property is that you don't actually use it. The purpose of owning investment property is to make money by having other people use it and pay you rent. What this means is that it's the capital value that's derived from the rental income, or the net operating income as we're going to see, that really makes the investor decide whether to buy this property or that property. In earlier and simpler times, the conversion between the rent after you take away the operating expenses, which we will refer to as the net operating income, was converted to the capital value, the sale price if you like, the purchase price, the value, simply by a process of capitalization. Today we tend to use more complex methods, partly because properties are more complex and partly because we have computers and we want something to do with them, and so we invent extraordinarily complicated spreadsheets to do the same job that you could do on the back of an envelope not so terribly long ago. And the development of the new and more developed approaches, discounted cash flow methods that you'll remember from property investment and financing, the decision as to, or the opinion as to which is the better form of valuation is a discussion which started pretty much as soon as DCF came into the property world and is still going. And so I invite you to give some thought to that as you go along. One way or another, the capitalization method is still very powerful and still very important, even though many of the more complex properties, say shopping centres and complex commercial properties, are now tending to be valued by DCF methods more and more. There's quite a difference between the way that DCF is applied to property for valuation compared to how it's applied for investment appraisal. However, we're getting ahead of ourselves. What I want to do here is simply go back to the basics, because you don't want to forget that the most direct form of valuation is always the best. And so that means we should never totally forget, in fact we should never ignore, direct comparison, even with complex properties. We may use elaborate metrics, value per square metre and so on. But direct comparison is always first. Then comes capitalisation, which uses historical data, therefore it's fixed and you can stand behind it in court. And then comes the more elaborate ones. And so what we're going to do is start with the basic income appraisal. We've introduced this in our first valuation subject. We're now going to look at it in a little more detail. So let's work through a very simple example to just brush the cobwebs away. Here we're looking at a very simple case, where let's assume that there is a net rent available of $10,000 per annum. Furthermore, we're going to ignore growth for this exercise. As it turns out, it doesn't really matter whether we put growth in or not, because capitalisation ignores any growth factors. It's actually assumed to be hidden inside the adopted capitalisation rate. The capitalisation rate we're adopting in this example is 15%. Some of you who have experience in the industry might say 15% is a very high cap rate for actual properties. That's true. And that is because in most markets today there is an assumption of at least a few percent of growth. And more or less for every 1% of growth, the cap rate should, in theory at least, reduce by about 1%. And so if the market is assuming a growth rate of, let's say, 6%, then it would be quite happy with a cap rate of about 9%. However, in this case, we're going to be leaving out growth for the purposes of simplification as we go into the future. Capitalisation, as is shown here, is simply rent divided by the cap rate.
We can calculate that quite easily in Excel, giving the data that we have already as the $10,000 of annual rent divided by the 15% of the cap rate. And that gives us a value for this property of $66,667. Again, those of you who are in the industry will realise that this number, precise down to the nearest dollar, is obviously far more precise than a valuer can actually calculate it. And so we could say about 66, 67,000, we might round to either 65 or 70 depending on the job. That's capitalisation. In theory, the investment value of any asset that is held as an investment, any capital asset as we call them, is the present value of all the future returns. In theory, capitalisation assumes that the net rent, in this case $10,000, is going to continue constantly in perpetuity, forever. And that gives us this $66,000. A more precise estimate of the present value of the future returns can be gained by looking at each year into the future, or each period if we want to use a different period, say quarters or months, and discount each one of those future cash flows down to the present. And this is basically what discounted cash flow achieves. And again, you should all be remembering this from earlier valuation studies. In this case, we're assuming that the net rent of $10,000 will continue off into the future. In this table, I'm only showing the first 10 years of the future. And as I do the calculations, I'm actually going to run it out for 99 years, which is the longest rents or longest leases that we tend to find in Australian markets. When we do that and we discount it by a discount rate of 15%, we find that the first rent, which I'm assuming will be received at the end of the first year, is discounted down to $8,696. And that's achieved by using a discount factor, where the discount factor is simply 1 divided by 1 plus the discount rate, in other words 1.15 in this case, raised to the power of the period number. In this case, the period number is 1 because it's the end of the first year. We can see that the discount factor reduces over time. So in the second year it's 0.756144, etc. In the third year it's 0.65 and something. In the fourth year it's falling down to 0.57, then 0.49, 43, 37 and so on out in time. What this suggests is that the cash flows in the distant future become progressively less and less valuable. And so there's an assumption that really the errors that we get from forecasting the future, because they're getting great as the uncertainty of the future spins further out in time, becomes less significant because the discount factor is carving into it heavier and heavier. In this example, I've assumed, for the purpose of the exercise, that we're only looking at 99 years rather than 200 or 1,000 or something. But even so, when I calculate the net present value, which is simply the sum of the return in the end of the first year, the second year, the third year, and so on, out to the 99 years, this provides an illustration of the fact that capitalisation is in fact a special case of a discounted cash flow valuation. The elegance of the capitalisation approach is that it is extremely simple. And secondly, and this is far more important from a legal point of view, it's based on data that can be taken from the evidence in the market. This is very important because when the valuer is called to account before a judge, he can say, I have looked at the market, I've looked at comparable properties. I have found that in this market for this type of property, they tend to be returning a rate of return, a net yield of 15% in this case, and I've applied that 15% to the rent that I'm certain of from the historical circumstances of this particular property. Both of these things are hard evidence, historical facts. And by applying the 15%, dividing the $10,000 by 15% and so on, you're able to get the capitalised value. Okay, so we've got the discounted approach getting within $1, but we have to run the model over about 99 years. This is obviously quite awkward. In practice, the discounted cash flow approach assumes only a limited number of periods. Furthermore, it assumes that at the last period, the property is sold. Not necessarily actually sold, but at least notionally sold. And to get the notional sale price at the end of the discounted cash flow period, let's say in 10 years' time, we use the tried and true capitalisation method. The assumption here is that even though we're using the discounted cash flow approach in order to get a more precise understanding of the behaviour of the cash flows, because the capitalisation method, which is assumed to be less precise, is going to give us some kind of a value, in fact the only value that we can calculate 10 years into the future as a forecast. Whatever errors are in the capitalisation approach in year 10 tend to be lost in significance because of the effect of discounting. You'll notice that in year 10, because there's no growth or decay in the rental cash flows, the property will return the $10,000 of rent. We capitalise it at 15%, and isn't that a coincidence? The value of the property in 10 years' time is $66,666 and so on. If we use this notional sale at the end of year 10 and then add to it the discounted values of the rents between years 1 and 10, and then sum them, what we find that in this case, while the first year contributes the same $8,696 and the second year contributes $7,500 and so on, by the time we sum those, plus the present value of the notional sale in year 10, the net present value is now $66,667. The purpose of this illustration is to show, first of all, the similarity between the results of capitalisation and discounted cash flow approaches, at least for a simple case, but also to illustrate the basic mechanics of the discounted cash flow approach. That is, the discounted cash flow approach uses that set of cash flows, the annual rentals, that I'm fairly certain that I can forecast reasonably well, let's say out to maybe 10 years, plus a notional sale at the end of the analysis period, in this case in year 10, using a capitalisation based on the rental at the end of the period. For actual discounted cash flow models, the net rental, which I'm assuming to be a very simple non-growing amount, may be a very complex calculation consisting of a number of independent sets of forecasts. And so while this appears very simple, it can be applied to very complex situations, and this is where the value of the discounted cash flow approach really comes in. It'll be useful for you, before leaving this section of the course, to build these models using Excel and also to check them using a financial calculator. You will find that the calculations necessary to build these models or perform these calculations have already been run past you in the finitude exercises that you would have completed in a previous course. I've included the finitude exercise as an attachment in this model that you may want to pull out and run through again if you're either a bit rusty or for whatever reason you've missed doing it in a previous course. Either way, it's vital that you do the exercise now, because we will be building on this exercise into the future, and you really need to be building up those Excel skills and the abilities with your financial calculator, because they are a vital part of what you'll be taking away from the course.